Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Tuesday, March 30th, 2010. Let's start by taking a look at the pound-dollar pair, which we left off yesterday was testing some important resistance levels. First, we had a horizontal resistance around the psychologically important level of 1.50, which had changed its role between support and resistance several times throughout the past month and a half. We also had a downward sloping resistance trend line connecting our highs back here when we reached the 1.5350 level. So we had tested both those levels in around yesterday's high, and in today's trading we see that we pushed above both of those, moving from around the 1.50 level to a high of 1.5125 in early New York trading. The British pound rallied after we had some strong economic data from the UK, as well as some hawkish comments from a Bank of England member, and polls showing that the Conservatives have widened their lead over the ruling Labour Party. We come to resistance now, around the 1.5120 level, and we could see that that was our high in last week's trading on Tuesday. So we managed to push above that level just slightly in today's trading, but right now that is holding as our new resistance. We have mentioned the 1.52 level as an important level, so that if we continue this rally, that's our next logical point of resistance. Taking a look at those releases, we had the final version of fourth quarter GDP come out in the UK, and it was revised higher to show 0.4% quarterly growth, which was better than expected. As we can tell from the chart to the right, though, we still have a long way to make up for the declines in GDP that we had seen during the recession. Still, the fact that we had the reading revised higher is a positive sign. The upward revision came as output of services, construction, and agriculture were revised slightly higher. In a second release, the nationwide housing price index jumped 0.7% in March, almost wiping away the 0.8% decline we had seen in February. The figure was better than expected, as forecasts had called for a 0.2% monthly rise. On the year, housing prices were 9% higher. While the data was good for housing prices, the housing sector did see some negative signs this week, as we had mortgage approvals unexpectedly fall to a 9-month low in February. Taking a look at the euro-dollar pair, we saw a rise in overnight trading, and we hit a high in the European session around 1.3536. However, since then we've seen a rather sharp decline in the pair, and it has moved below its 50-period moving average and below the 1.3450 level, testing its low around as of 12 a.m. Eastern at 1.3394. The markets began to focus again on the fiscal issues still facing Greece, as we had Greek bonds come under selling pressure. The euro had initially rose to a high of after it was buoyed by the fact that Greece had managed to raise 5 billion euros in its bond offering yesterday, since Germany and France agreed to provide a backstop lending facility with the IMF. However, the spread on 10-year Greek debt over German bonds widened at 1 point to 3.35% Tuesday morning from 3.16% at Monday's close. So it's the same problem. Greece has to finance its selling of bonds, and right now the market is demanding a higher yield. Zooming this pair back a little to show more price action, we did see the 1.3550 level was an important level of support that was broken in last week's trading. And now we could see that we had retested that low here from early March in today's session. We had a second very important level of support going back to late February around 1.3450, and we had managed to move above that level in yesterday's session, but now we fall back below it today. So this is a very weak development for the euro, as the bounce back following the EU IMF plan for Greece, the rally from that seems to have faded rather quickly. Plotting a Fibonacci retracement from our high of 1.38 to our low around 1.3250, we see that the rebound was 50% retracement of this downswing. So now we test the 23.6 part at 23.6 Fibonacci retracement level as support. Adding to the factors weighing on the euro in the New York morning session were news that the IMF cut its growth forecast for Germany and warned that there are substantial downside risks caused in part by weakness in the banking sector because of exposure to southern Europe. The euro is also pressured by the newfound strength in the pound. As you can see here, we had a rather sharp move in favor of the pound, testing our support from last week around 0.8885. Now let's switch our focus to U.S. fundamental data as we had the Standard & Poor's Case-Shiller House Price Index come out. The 20 City Index in annual terms for the month of January was down 0.7%, which was an improvement over December's negative 3.1%. On the month, prices climbed 0.3%, which was better than expected and matched the gain we had seen in December. The year-over-year decrease is the smallest in 3 years. The 10 City Index, meanwhile, in annual terms, showed flat housing prices compared to a year ago. While the data shows some stabilization in housing prices, in order for the housing market to really recover, there needs to be gains in hiring, which would overcome the mounting foreclosures seen in the market, which has been keeping pressure on prices and continue to pose a threat to renewed declines to the real estate market. In a second report, the Conference Board Consumer Confidence for the month of March rose to 52.5 from February's 46.4. That arrests a 3-month slide in confidence as both the present situation and future expectations rebounded. Still, these levels are lower than what we had seen in December and January as consumers continue to be worried about the labor market. However, as we expect Friday's non-farm payroll release to show a rather strong burst of job growth, it seems that consumer confidence is firming and should continue to do so in the coming months. Following the consumer confidence release, the US dollar-Japanese yen pair hit an 11-week high just at the 93 level. That moved us out of a triangle consolidation pattern after we had seen a rise in the dollar-yen pair last Wednesday. A move higher in US yields was a key driver for the greenback's gains against the Japanese currency. Before we move away from the yen, let's take a look at some Japanese releases we saw during the Asian session. Household spending for the month of February was down 0.5% compared to a year ago, which was a figure that was much worse than forecast and shows that Japanese consumers have retrenched yet again. The unemployment rate did remain at 4.9% as expected, though industrial production for the month of February was down 0.9%, a weaker than expected result. Taking a look at one of our commodity currencies, the US dollar Canadian dollar, we saw a rather strong move in favor of the Canadian dollar as we had higher commodities overnight, but we did have a pullback to that move in favor of the loonie in New York trading as US stocks, which had started the day positive, have moved into the red and causing a bit of risk aversion in the general financial markets. So we did have a rebound to this move in favor of the Canadian dollar, though it extended the move we had seen in yesterday's session as we now test our lows from last week around 1.0150. So we'll see if we have a bit of a bounce of support and to counter this move, or if this is just a bump in the road as we attempt to move further down in this pair. The Australian dollar US dollar pair, meanwhile, moved higher in overnight trading, testing the 0.92 level, which we had said was our important level of resistance. We moved above that level prior to the decline in US stocks, so that's a positive sign that this resistance level is being broken, and perhaps we're going to see a higher move to our next level of resistance, which is the 0.9250 level. Now, we did have a rather strong rally in the past 2 sessions, so we may see a pause and some consolidation prior to our next leg up. So that'll do it for our look at market highlights and fundamentals for this session. Let's take a look at what to expect in the coming trading session. Tonight is going to be a pretty important day for Australian data as we have retail sales, building approvals, and private sector credit coming out at 8:30 a.m. Eastern. Also tonight, we have data from the UK on consumer confidence and the Japanese manufacturing PMI. Overnight, Germany posts its unemployment change, and that will be followed by the Eurozone unemployment rate as well as some consumer inflation data. Tomorrow in the US, we have the ADP employment change, the US Chicago PMI, as well as a look at factory orders. From Canada, we get a look at the monthly GDP change for January. And that will do it for today's broadcast. For more news, videos, and analysis, please visit our site fxtimes.com. I want to thank you for watching and wish you good trading.